Executive editor Brian Sazian are taking a look at a live shot of the opening bells on Wall Street on this Thursday morning. C1 Fund ringing the bell at the New York Stock Exchange. Firefly Aerospace getting things popping over at the NASDAQ. Couple stocks top of mind for me out of the block here. Airbnb getting pounded on weak third quarter guidance. True story, I've only used Airbnb once. More of a Marriott or Hilton guy myself. A rare win for the well-compensated David Zaslav at struggling Warner Brothers Discovery. The company managed to post a profit. Shocker. I like the Disney quarter yesterday way better, and those WWE and NFL deals are very wow-like. And I'm waiting the debut of SpaceX rival Firefly down at the NASDAQ, like I just mentioned, later this morning. Looking forward to chatting with CEO Jason Kim following what could be a strong debut for the space exploration outfit. Here's what else I'm watching this morning. Number one, it's Trump tariff time again. Fresh tariffs from the Trump administration went into effect today. The highest rates imposed are on goods from Brazil at 50%, all the way to 35% for Switzerland and 25% for India for now. Markets now have to decide, should it care about the profit headwinds from tariffs, or is it still worth partaking in the FOMO vibes? Number two, kissing the golden ring. Apple CEO Tim Cook presents President Trump with a new gold trinket and promises to spend $100 billion more on U.S. companies and suppliers over the next 4 years. But is the Tim Cook charm offensive on Trump really going to score a win for Apple shareholders? We'll discuss. And number three, on the lookout for the tech tariff whopper. Staying on tariffs, President Trump said the U.S. will impose a tariff of about 100% on imports of semiconductors. The kicker here, it may not apply to companies that are manufacturing in the U.S. or have committed to do so. Could be a nice win for Taiwan Semiconductor and market darling NVIDIA. My roundtable for today, Infrastructure Capital Advisors CEO and CIO Jay Hatfield, Threadneedle Ventures founder Ann Barry, and Yahoo Finance senior reporter Inez Ferre. And I want to go to you right off the jump. You know, this market has been on absolute fire, FOMO in full effect. But is this the moment where investors should take a step back, take some stock on how far the markets have come, and show a little more respect to these tariffs that just went into effect today and how they might shape corporate profits?
Yeah, I think we're well past the point where investors should have taken stock to step back and pay some respect to the tariffs that have been looming for a long time. I think, Brian, to the point of the macro data, we are seeing real signs of slowness. We're seeing it in the labor markets. We're seeing it in the services data that's coming out. And we've had industrials companies like Caterpillar, like others, clearly coming out saying the tariffs are hurting us, and that's only going to go up with the tariffs coming to effect today. The other piece I would say here is even those companies that seem to be getting exemptions right now, they are exemptions based on actions like huge investment in the United States that, quite frankly, I don't know they're really going to deliver on, or are going to deliver on very slowly. So I can see some of that being walked back and some of those exemptions being removed. I think it's a really tough time to be adding positions right now.
Jay, devil's advocate here. The market has ignored tariffs for the better part of 3 months or so, maybe a little bit less. Why can't it continue to ignore these tariffs?
Yeah, so we have a non-consensus call. Thanks, Brian, for having me back. That tariffs are actually good in the long run for the U.S. economy, not necessarily the rest of the world, for a couple reasons. The main reason being that it reduces the U.S. budget deficit, lowers interest rates, increases private investment, so less crowding out. So that's really the most critical. We think that raises economic growth by 0.2%. And then we do think it's more of a winners and losers situation. So companies that were importing a lot of material and products from overseas, like a General Motors, are going to be disadvantaged, but a Ford advantaged because they're producing in the U.S. And in the long run, also, you're going to get more sales, both of exports where we have deals, or because the tariffs are restricting competition from overseas. So we think it's a net positive to have these modest tariffs of 15 to 25 for most of our trading partners.
And what am I missing here? I get where Jay's coming from, but is that what the market has been thinking here internally, that tariffs are in fact good?
I don't think the market thinks that tariffs are good, and I also don't think the market thinks that these tariffs are modest. I think that what's happened here is a setting of expectations by President Trump with the idea that tariffs would be set at catastrophic levels. And we've seen them walk back from those catastrophic levels, which were announced on Liberation Day, to levels that are still incredibly high, 3 times or more higher than have been in existence over the last several decades. And I think the market has taken huge sighs of relief, and that's where we've seen these rallies. But I think the bigger point here, Brian, on why the market in general has moved up, it's the concentration issue that we've got. We've got enormous concentration in software companies, enormous concentration in companies like NVIDIA that have been seeking exemptions, like Apple, and that's moved the entire market, the entire indices upwards. So I think parsing the detail, parsing by sector, is what's really going to be important for investors looking to try and find longer term returns here.
Inez, it's essentially what, a 7-stock market in the Mag 7, right?
Yeah, and the NASDAQ is on pace to close at new highs today. Look, like these guys have been talking about, this Trump headline has been now, if you make a deal with the U.S., we will not put tariffs on your products. And that's what happened with Apple. And like Anne was saying, it will remain to be seen the timeline of this because we will be having midterm elections. And then in a few years, who knows what will happen with the next administration and if everything else will get turned around. But definitely this is telegraphing to the world, make a deal with us to do manufacturing here, research here, and then we won't tariff you. But we also have guests that have talked about this tariff issue, that it's been talked about on earnings call. There is more clarity now with some of these numbers. Yes, it will. Yes, some companies will take a hit on earnings, but then we should be going back to fundamentals later on. But I do want to note that more than 82% of the companies that have now beat on their earnings. So the AI trade is really what's driving a lot of this. Tech is driving a lot of this. And as one guest earlier this week told us, it's hard to find any bear when it comes to the AI trade. So maybe what we're seeing is that enthusiasm about tech moving us forward.
I talked to Wilbur Ross, of course, former U.S. Commerce Secretary and opening bid. I asked him about tariffs and how long they may stay in place. Take a listen. I'd love to get your reaction on the other side, Jay.
His target is really improving our balance of trade. That's one of his major objectives. And that can either be done by holding back the trade of foreign countries through tariffs or by everybody cutting it together.
Jay, the Commerce Secretary, former Commerce Secretary, essentially making the case that we are going to have to live in the land of tariffs perhaps for the rest of the Trump administration, and they may not come down. Would that still be good? As someone that views tariffs as good for the economy, having tariffs in place for about another 4 years, is that a good thing?
Absolutely, because it's better for the economy to tax consumption and not investment. So that gives rise to our estimate of a 0.2% uptick in long-term growth of the U.S. economy, and of course a sustainable budget deficit. So as we said before, we would agree with Wilbur Ross's first scenario, like we're going to have tariffs. Luckily, they're not going to be 130%, but in this 15 to 25% for most countries. And that's going to put pressure on the rest of the countries to come to a deal, because then, of course, we'll be importing from the lower tariff companies, or countries rather. So we do think it's sustainable. We think it's good economic policy. It can really only be imposed by the president, because it's very unpopular to increase prices, increase taxes. So it's the only real way to get to fiscal conservatism is by imposing it from the president. If you actually asked or tried to pass this through Congress, it would not happen. A company right in the middle of all this high tariff drama is Apple. And I mentioned at the top of the show this somewhat gold trinket that Tim Cook, Apple CEO, gave President Trump yesterday at the White House. It looked like the award that I got for my Employee of the Year award 15 years ago, probably ordered from office.com. You can see it right there. I guess that's partially gold. And whatever it is, whatever the case, if you're an Apple shareholder, do you feel better today that Tim Cook might be back in the better graces of President Trump, or this relationship could go south very quick?
Look, I feel better that Tim Cook is being a consummate politician, and whether we like it or not, the job of the CEO is to do what's best for their shareholders, and that includes having relationships with the most powerful decision makers in the country. That includes the president. What I would say, though, as the shareholder of Apple, and I am one, I'd be very careful not to confuse good politics with what is actually going to happen in the operations of this business. When we think about this incremental $100 billion investment commitment, let's actually walk that through, Brian. Tariffs could change 3.5 years from now. the time it takes to build a new factory, to get permits for a new factory, to break ground for a new factory, to construct it, hire workers and train them totally goes longer than the next 3.5 years. I highly doubt that Apple is going to start breaking ground on as much new kind of land that this kind of number would imply, knowing the uncertainty at the back end of this.
And as that award that we were seeing on the screen reminded me, I got to give you an award for bringing the fire here, opening bid from day one. I don't know what that award's going to be, but it's going to be a lot better than that one right there we're seeing on the screen. I mean, still not, I'm not sold on that thing. But Inez, look, Apple just warned, last week on earnings, they're going to see a $1.1 billion hit to their profits because of these tariffs. That's not going away overnight just because Tim Cook showed up with a somewhat cheap trinket in the Oval Office.
No, it's not. But look, the stock went up yesterday. So definitely investors felt that this was a good move that Tim Cook made. It was very visual, and you could see that it's a headline that was positive for Trump, but also positive for Apple in a way because, look, everybody knows that this is a transactional deal. It's no coincidence that this announcement also took place on the same day that the Trump administration said that it was going to impose another 25% tariffs on products from India. So the fact that there's been a carve out for Apple because also there's this big investment that's going to go on, which as Anna was just saying, it'll remains to be seen because these investments take so long to make. But this certainly bodes well when you think about also semiconductor firms and the threat of tariffs on semiconductors, because you know that there are going to be more deals coming, or at least more commitments for deals coming. Whether or not they eventually take place, that remains to be seen. But certainly investors already know this is transactional. It is a headline and it is an announcement, but it remains
No, it's
to
a
be seen what
bromance.
happens.
Inez, come on, it's not transactional. There's a bromance here. I mean, Tim Cook and Trump, definitely probably not. All right, straight ahead, Intel's new CEO looks to be on the ropes. Only 5 months into the new gig, and Airbnb shares are getting routed after earnings. Have your analysis on this one coming up. Welcome back to Opening Bid. As if Intel's new CEO, Lip-Bu Tan, didn't have enough headaches on his hands, let's count them, because we have the time. Intel is seen as an also-ran in chips to NVIDIA and AMD. Its financials are in tatters because of years of execution miscues. And now Tan finds himself under fire from the president barely 5 months into the top C-suite gig at Intel. President Trump taking to Truth Social today saying, quote, the CEO of Intel is highly conflicted and must resign immediately. This is top Republican Senator Tom Cotton on Wednesday sent a letter to Intel Chairman Frank Leary voicing concerns about potential ties to China's Communist Party and military by Tan. Intel didn't return my request for comment, but this I can confirm for you. Intel stock is down 58% in the past 5 years compared to an 89% gain for the S&P 500. All right, let's turn now to our stock of the day, Airbnb. The shares aren't getting booked by the bulls. In fact, the bears are checking in for a stay. Who writes this stuff? On the surface, the company's second quarter earnings report ticked a lot of boxes. Revenue rose 13% and beat estimates. Net income rose 16% and also beat estimates. And the company's current quarter guidance for sales, which captures the peak summer travel season, came in above estimates at the high end of the range. All good things here. Dig underneath the surface, though, and you can understand why Airbnb is in the penalty box. For one, the company warned that booking growth in the third quarter won't match the 8% growth rate hit last year as Trump tariffs sink in and possibly weigh on travel. The company is also spending $200 million to invest in new services and experiences at the expense of profit margins. With Airbnb stock still priced at a premium to hotel plays Marriott and Hilton, as you can see on the Yahoo Finance platform, bad guidance on sales and margins will not be well received by this market. So what's the play here on a stock that has lagged the S&P 500 all year long? Still with me is my roundtable, Jay Hatfield, Ann Barry, and Inez Frey. Inez, we have not, I'll start with you, we have not gotten a good read on the travel season. Marriott, not a squishy quarter, weakish guidance, same deal at Hilton. Now Airbnb saying, look, we're not willing to put out blowout third quarter guidance, even though things stabilize towards the end of the quarter in terms of sales.
Yeah, it's been a bumpy ride for the travel stocks. And part of this, of course, was in April during the tariff announcement. A lot of companies talked about how their bookings, travel went down in April, where really the consumer really paused in April. But then you saw an acceleration in July. And in the case of Airbnb, as you were mentioning, the tougher comps is one of the issues. I think also Wall Street is looking at that $200 million investment that they're making in new businesses as well and seeing where the payoff will be there as well. I mean, one of the things that Brian Chesky talked about during the call was loyalty programs when he was asked about that, because he did say, look, we are at a disadvantage when it comes to the hotels that have these loyalty programs, and they do want to put something forth regarding loyalty. It won't be exactly the same as what hotels do, but nevertheless, he said that it will be not immediate, but in the future they will do something like that. And I think that Wall Street is expecting them to do something to compete more with hotels that have really had the opportunity to become better when Airbnb was skyrocketing and hotels were on the low. Well, now hotels are back in vogue again.
And cut through all the fluff on Airbnb. At the end of the day, this is a company, it's still viewed as a growth stock tied to the fortunes or lack thereof of the consumer. Any interest in names like this on pullbacks?
Not on my end, and here's why. I think when it comes to Airbnb specifically, the market can't quite commit to, is this a software company and a tech company and should trade close to one? It's trading at 20 times EBITDA, or is this a hotel company and should trade closer to those peers? And it sort of flip-flops between the two. And I think what we really saw coming out of the earnings today is if you're going to look at it like a hotel company, this was soft guidance. It wasn't a strong outlook. The market didn't like that. And the investment that's going into the more tech aspects of it, the booking, for example, for more services, there isn't a ton of conviction around it yet. It's still early days to see if services and experiences bookings are picking up, and we haven't seen the return quite yet on the new investments. So it's not performing like a software stock right now, and it's lagging as a hotel one.
Jay, really, as earnings season has gone along, we've gotten weaker and weaker reads on the consumer. Are you starting to get worried about that, especially in the context, again, it's another one of those things like tariffs this market at records is ignoring?
Well, we think that they may have been ignoring it up until Friday. We think, and Airbnb is a good example, that this is a tale of two economies. The old economy is in recession, and that's evidenced by construction being in recession over the last year, housing being in recession, and that filters through to the consumer. So we've been avoiding old economy exposed stocks and then focusing on new economy. The only thing interesting about this tech boom is it also benefits energy and utilities and some industrials. So that's really the market where you have earnings momentum. Old economy, anything linked to housing, the consumer, construction, employment, negative. But we don't think we're in a recession because this is the biggest technology investment boom. And it's really investment that drives recessions, not the consumer. It's after the investment drops, there's layoffs, and then the consumer rolls over. So we don't think the consumer is going to go, consumption is going to go negative, but investment's already flat. Fed needs to cut rates, and then we'll be fine after they cut rates.
All right, let's keep this train moving. It's time now for our question of the day. President Trump later today will reportedly sign an executive order to allow private equity, real estate, crypto, and other alternative investments in 401ks. It stands to be a huge win for the private equity and crypto industries. But my question is this: would this move create an insane amount of new risk in 401ks? Remember, 401ks are supposed to be one's retirement nest egg, not another whipsawed stock trading account. And I should note, I reached out to the White House for a comment on this. They did not return my request for comment. Jay, let me go back to you here. I'm curious on what you think about this as someone that is thinking about investing from a more longer-term standpoint.
So I would say yes and no. So private equity funds have legitimate companies that produce cash flow that over time trade at reasonable multiples, whereas Bitcoin is a great gambling vehicle, probably will work, particularly during the Trump administration. But I'd hate to see people build up big crypto positions in their 401ks and then have it crack. And keep in mind that you can create an infinite amount of crypto so that eventually at some point the bubble will burst, and I don't think you should hold it in your IRA.
And I mean, you have to agree with that, right? I shouldn't be cashing out of my 401k, or I mean, just keeping my 401k and calling folks up, I believe it's Fidelity in my case, and saying, hey, I want to get into crypto. I want to rotate out all my dividend payers and own a 401k of crypto, and hopefully I can retire safely in 75 years.
Well, I want to pass the difference between speculative investments in crypto, and lots of people have different perspectives on that, and actually talking about private equity, which I have a long background in. Not all private equity is created equal. If you take a look at blue chip private equity, which is leveraged buyouts of mature businesses, high cash flowing, for a long period of time, pre this AI investment boom, a lot of the top decile private equity funds were actually outperforming the stock indices, Brian. The reason being that you've got an ownership group that's highly engaged in pushing optimization in a way that, quite frankly, boards of public companies aren't necessarily holding management teams accountable to. So the idea that everyone with a 401k can get exposure to the top quality private equity firms, I actually find encouraging. I think that the important thing is getting educated on the different kinds of private equity there. It's different for venture capital, which is very early stage and high risk. It's different for growth. It's different for private credit. It's different for infrastructure, which Jay's involved in. So I think the sweeping term private equity needs to be unpacked. I think there's opportunity there. There's also risks.
Inez, last word to you, risky or not?
I mean, it's risky, but this speaks to the bigger theme from a retail investor point of view or from a point of view of a regular worker that puts money into their 401k. And why we're seeing crypto at Bitcoin at 116 right now is because there is a currency debasement going on. Everybody sees it, and investors or retail investors that are putting money into their 401k, you may not be getting a lot of pushback from them because they're thinking to themselves, I want to make sure I retire on time. And that's why they keep on taking more and more risk.
My favorite roundtable of the week. Thank you so much, you all, for hopping on. Ann Barry, Jay Hatfield, and Inez Ferre. Talk to you soon. All right, the trading day is underway, and in financial markets, every second matters. What you do right now can determine your financial future. With that, I leave you with this thought for the rest of the trading session. With the fear of missing out, better known as FOMO, penetrating markets right now, it's best to keep one age-old investing lesson in mind: show and feel no emotions. I think former TD Ameritrade CEO Joe Moglia said it best when I talked to him earlier this week.
Fear of missing out on markets will probably go on for the next decade or so. And it depends on what's going on. When markets are doing well, retail investor feels they got to be involved. And if the market's running, then they feel they got to catch up. The issue with that, Brian, is that it's an emotion. It's an emotion. And I think whenever you're dealing with the marketplace, whenever you're looking at your portfolio, when you're looking at the economy, while it may get emotional sometimes, you cannot make decisions emotionally.
Who am I to disagree with Joe Moglia? So keep that steady hand in place, friends, and do your own homework. Straight ahead, Julie Hyman will serve you up the news behind the news behind everything moving in the market on Market Catalyst. And I'll pop in for the NASDAQ around 11 a.m. with an interview with Firefly CEO Jason Kim. Big IPO day for the space exploration company. We'll be right back.